But I think the first gusher could take you up into the mid 50s to 60 so fast, like I'm talking a couple of months even. It's been done before in silver. If you go back and look at the action in 2010, 11, there was a gusher. Silver like doubled in a matter of some months. And back in 1980, same story. Now, those were tops once it was through. This time, it's not going to be the case. This time, it's just a quantum leap into a new reality. And I think ultimately will drive further. But right now, just on a short-term trading basis,
highs. This will be a yearly defined higher high. Guys, this is it. That's it. Yearly, it's done.
And after that occurred, of course, I then shifted all my technical attention to momentum analysis going forward. Price charts to me were secondary. And that right now, this is what we're looking at. The flow could be massive, especially into the gold miners, which is a trivial little sector. I mean, it'd be like wet bar of soap being grabbed.
Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel, where we're bringing the VRIC to you each and every week with our series of expert online panels. And today I am joined by Michael Oliver of Momentum Structural Analysis and Patrick Karim of North Star Bad Charts. This is actually a repeat of the very first panel I ever hosted on this channel. So I'm very excited to have both these gentlemen on once again. It's great to have you back on the VRIC channel.
Good to be back.
Hi, guys.
Well, I want to start with silver. Patrick, you recently posted a couple of charts on X with this caption: "This cannot be unseen. Silver's pathway to over $100." Michael, you also posted, "So now that the FOMC noise is gone, it is even more apparent that gold and silver are breaking out and about to go on a bender." So let's hone in on silver first. Break down what you're both seeing for us. And Patrick, I'll go to you first.
Man, that title sounds so clickbaity. I would never do that. Are you sure that it's me? No? Well, okay, I'll share the screen because an image, guys, like there, it's worth 1,000 words. Okay, this one here. So, okay, look, to remove noise there, like you often see that in parabolic melt-ups, like in the 1980s, the price went up super high. And then even in 2011, it ran up. But what I love to do is just go on the year. Okay, guys, this is big picture. This is yearly candles. So each one of these candles encompasses the whole trading year. But you see that what's more meaningful for the price action is where did it remain the longest period of time? For me, those are the levels that, okay, if we're above where like the bulk, the chunk where a lot of trade happened and where price went up, for me, that's more meaningful than the top, because often people compare, oh, silver, it's still off. It's a 1980 high. Yeah, but goodness, it's a parabolic melt up. It didn't stay there long, guys. That thing is like, for me, it's less meaningful. It still has some meaning there on the smart timeframes. But look at that. So in 1980, we didn't have silver close above whatever. It depends if you use the futures or spot or something around $30, $31. That was the peak in the 1980s. 2011, pretty much the same area range, 30, 28, $31. And look where we are today here. I did a little zoom in here inside. And silver is testing that level, guys. Look, by the end of the year, if silver could hang on to this and even close convincingly above that 31 level, let's say close the year at 33, whatever it is there, wow, this is a signal that we don't, like, I don't want to be make this like a bigger thing than it is, but it is kind of big because that line goes back all the way, like, to 1980, man. And like whatever you want to call this, cup and handle, valid or not valid, guys, I don't care. This is a higher low. And now we're hitting horizontal resistance, and new uptrends are defined by higher lows and higher highs. This will be a yearly defined higher high. Guys, this is it. That's it. Yearly, it's done. And on that chart, just want to show you guys that this is for me, the biggest macro thing that silver tracks. It tracks very accurately. Well, I haven't seen a ratio chart that silver tracks more than gold adjusted for inflation. So when somebody tells me silver is, it's mispriced or it's not tracking gold, guys, this chart's telling me that silver is like a beta play. It's derivative of gold performance capacity to outperform inflation. And look at that. Look at gold. It's above. It's a 2011 high. It's above its 1980 high. Man, unless a disaster happens in the next 3 months, this is like bonkers stuff, man.
And Michael, your thoughts?
Yeah.
The yearly candle methodology is one of the most underused tools in technical analysis, and Patrick Kareem's application of it to silver produces a result that is almost impossible to argue with. The $31 level is not an arbitrary line. It represents the highest sustained annual closing price that silver managed in both of the prior major bull markets, 1980 and 2011. In both cases, the spike to $50 was an intramonth or brief parabolic move that did not produce a yearly close above $31. Silver came back down. The range held. Now, for the first time in 44 years, silver is testing a yearly close above that level. If it holds and closes convincingly above $31, the 44-year ceiling becomes a floor, and by definition, a new uptrend on the longest time frame that matters has been confirmed. This is not a trading signal. It is a generational chart signal.
If you put those on a log scale, were those log scale, Patrick? I'm not sure.
Yeah, those were all log. I could put it back there.
I mean,
but
if you take the
Yeah.
swing moves in gold, you know, the past couple bull markets, the last 50 years, and do the same thing again, a good $8,000 gold just to match them, you know, in terms of log ratio scale move. Those moves lasted a decade or so. Either, you know, ours started in late 2015. So, you know, another year or so wouldn't shock me. We're $8,000 or even higher. There's so many events out there that are going on that are fundamental and technical that this time around it's likely to be exceptionally dramatic. And so, like you pointed out, silver, it did have two intra-month spikes up to $50 at each of those moves, but that was like, you know, thin air last few days. So really, on an annual basis, you nailed it. I wasn't even aware of what you showed till we saw it, but we're there, and it looks like an overlay of the gold chart the way you've done it there, which is accurate. And I think silver, if you do a ratio of silver to gold, go back 50 years, and let's say every year plot the highest level that silver was in relation to gold during that year on a percentage basis. You know, what percent is silver expressed as a per ounce of gold? Right now, silver is like 1.2 something plus, 1.2%. But if you go back 50 years, the number of years in that 50-year period where we've been up to 2% or 3% is almost normal. It's not like an aberration. So good grief, if gold went to even just 8,000, another replica of its prior ratio moves, and silver were to go to 2%, you do the math. Wow, you know, okay. So silver is definitely the one that we're focused on. As for participation, yeah, gold's the mama market, but silver is, the dynamics are far greater on a percentage basis.
Quick break here, guys. Today's episode is brought to you by Copernico Metals. Now, regular viewers of my channel will be familiar with the entrepreneur behind Copernico. His name is Ivan Bebek. Now, although a young man in this business, Ivan's already created tremendous value for his shareholders in the past, namely with Caden Resources, which he sold to Agnico Eagle, and Keegan Resources, which became a mine now owned by Galiano Gold. Now, Ivan has surrounded himself with expertise from BHP, Newmont, and Barrick on his board at Copernico Metals. Check out copernicometals.com. Now back to the interview.
And yet when we look to sentiment, silver is kind of in the basement when it comes, at least if I'm gauging by what I read on social media and what I see in the YouTube comments section. Trust me, there's going to be at least a few people in the comments here talking about how useless silver is. They've been stacking silver in their basement for years and it's done absolutely nothing, and it was the worst trade they've ever made, et cetera, et cetera. Now that obviously speaks to the fact that people are trying to treat physical silver in their basement as some kind of investment with massive upside potential, when I think for most people, physical silver is more savings. What are both of your thoughts there on how low the sentiment is in the silver sector right now? Does that make it an even greater opportunity because so many of the market participants are kind of have disdain for silver? Patrick, I'll start with you on this one.
Yes. So sentiment, yes. The way like, you know, it's weird because on Twitter, like you have daily defined sentiment, like just like charts, I have a yearly chart reduces noise. We could have spikes in sentiment on the shorter time frames, which could say we're approaching a top. But then if that sentiment is like really, there's a lot of it and it's over weeks and over months, then when it crescendos upwards, then we could have some type of more important top. But yeah, it's like nobody's talking about silver. My CNBC is not talking about silver. My aunt's not talking about silver. My father's not asking me. He's not even asking me about gold. My dad, and he's like from Lebanon, so he knows like how to protect his assets, but he's not. It's like there's it's crazy stuff. So even gold has went up so much already, and silver is like it's hogging this breakout line. Yeah, the sentiment, it's you need bullish sentiment to break these levels, but I think whatever we have here on the landscape of having blow off top type of euphoria, bullish sentiment, goodness, we're not even. It's like it's nothing yet. I wasn't there in the 70s. I don't know. I must have been crazy during the Hunt brothers. Like the sentiment, that must have been crazy. And today is going to be amplified, so much more. But yeah, there's no really bullish sentiment right now there. I don't feel it at all, right? Yeah, it's like, yeah, I feel like, no, I don't see any, there's no like laser eyes or there's nothing like that, right? It's like, remember Silver Squeeze? Even now, Silver Squeeze,
Yeah.
nothing's trending of the sorts, right? We're not hearing
No.
anything of the sorts. And we're at $31.
32 as we talk. 32 now as we
It's
talk.
at 32 now. So
Yeah.
there you go. But there's no
no,
Silver Squeeze now this time. It's crazy.
The sentiment picture for silver right now is the mirror image of what top callers look for. At a genuine top, at the Hunt brothers peak in 1980, at the 2011 peak, sentiment was everywhere. Everyone was talking about silver. It was on magazine covers. Taxi drivers were asking about it. Today, silver is at 31 to 32s, having broken above a 44-year resistance level on the yearly chart. And Patrick Karim's father, a Lebanese man who inherently understands hard assets better than most Westerners, isn't even asking about gold, let alone silver. This is the lowest sentiment environment imaginable for a metal that is simultaneously breaking out on the yearly chart, breaking out on the spread chart versus gold, and facing the most acute supply-demand dynamics in its industrial history. The combination of near-zero sentiment and breaking charts is precisely the setup that precedes the most violent price moves.
I think there will be probably an event that's isolated the silver. There is one unique attribute of it above and beyond the monetary aspect, and that is its industrial use. And, when you were a very young guy and I was a young man, silver was industrial use, was photography. That's gone. Okay. Now, the solar panels. And, if you look globally, if 80-90% of the photovoltaic cells and solar panels are being produced out of China. And I've read, and I don't keep up with the fundamentals that much, but in Latin America, the Chinese have really come into that market to gobble up the silver production. And I've even read that they're paying more for raw silver ore than they're paying the pure per ounce cost of silver. And because it's an essential ingredient in a photovoltaic cell. And its cost factor doesn't apparently impact the overall price of a solar panel. So in other words, if silver goes up, it doesn't discourage people from, consuming solar panels. But they're selling this stuff in Asia and in Africa. And if you think about it for a minute, these countries are emerging, into the modern world, and they don't have what we've all got, which is, power lines under the ground from a power generator down the road, and therefore a lot of these people use cell phones and so forth, but they got no power. And so the demand for solar power, in your backyard type thing is incredible. And it's growing globally. And China, and I've read statistics on it that it's, got every year it increases sharply in terms of industrial demand. Well, we all know the supply demand of silver is fairly tight. Nobody cares, right? Okay. But if all of a sudden this story suddenly gets amplified, in some way, some manner or form, where people suddenly become aware of this unique attribute of silver, which has, been around for a while, but nobody's been paying attention to it, then you could have this squeeze effect, that's unique. That silver's got this unique thing above and beyond the fact that it's a monetary metal. And I could see silver go berserk at that point with that kind of headline, and of course all the doubters out there. And when you run a market letter or research reports, you get emails from people. And from our retail subscribers, not our institutional ones, but our retail subscribers, we quite often get, oh gosh, this silver's just behaving like heck. What do you think? What do you think? That kind of thing. And it's more negative sentiment than it's positive. And so I can feel it. And Patrick, you probably can too, that there's just, the skepticism is prevailing. It's
Yes.
not an enthusiasm yet.
No,
Well,
they're looking for a, I don't want to interrupt, but they're always looking for an exit. It's like, okay, it
Yeah.
went up a few pips from where I bought.
let's get
Is
out.
it,
Yeah,
Patrick,
it's
is it time
over.
to
It's
exit?
over. Yeah.
Yeah. And I said,
Yeah.
no, it depends on what time frame, but on the monthly, it's
Yeah.
like the distance from moving average, something that I learned from Michael. There's room to run. It's when you're stretched away from a mean that you go, oh, okay, hold on there. We're stretched, But now when you're coiled and tight, that's where basing patterns are for. That's where people get discouraged. The bag holders I bought before, they give up. All the reasons, tax loss seasons. Insert your favorite fundamental reason why you would sell. That's the basing. But when all that's complete, and the moving averages are coiled tight in the market, okay, I have to reprice. Like it's starting to detach from that base, and it's going to try to vacuum up to find somewhere a place where it needs to consolidate. And we're just taking off now for that recent consolidation we had.
Yeah, since May, and it's silver starting to. We plotted, like I discussed, the ratio of silver to gold price per ounce, so what's percent of silver to gold, and that is rising above 1.2 right now, which is dirt cheap, by the way, historically. I mean, to have silver that cheap, we all know that. You get above 1.3, and there's a structure when you plot the chart of the silver gold ratio. You get much above 1.3, and you break out on that spread chart, which says, I'm going to launch. And I have this suspicion that maybe by the end of the month we'll be there. And that will be a signal that coincides with silver bursting out of this recent range. The high back in May was 32 plus, okay, dropped down to 29, and back up to 32 again in, I think it was July. Sold it again there, got to 32.70, but not 33. Okay, so if you're keeping a point and figure chart, you're doing your X's up to 32, down tick to 29, back up to 32, and then they whacked it again and went down almost to 26. So down ticks that took out the prior column low. So everybody said, oh my gosh, that's a top. No, it's not. You don't go back to a double top on point and figure. You're back there now. We're sitting at a triple top on a price point and figure chart. So a guy who's a simpleton point and figure guy doesn't look at anything else. He says, my goodness, we're sitting here at a triple top. Don't use the word top. It's a triple pending triple top breakout. You touch 33. And I think that next dollar is likely to ignite more interest and a vacuum effect. Our best guess is that, I think Patrick's right. We're going to 100, 200, something like that. And probably in a year or so. But I think the first gusher could take you up into the mid 50s to 60 so fast, like I'm talking a couple of months even. It's been done before in silver. If you go back and look at the action in 2010, 11, there was a gusher. Silver like doubled in a matter of several months. And back in 1980, same story. Now, those were tops once it was through. This time, it's not going to be the case. This time, it's just a quantum leap into a new reality. And I think ultimately will drive further. But right now, just on a short-term trading basis, don't be shocked if you see silver gush up into the mid 50s to even $60 area. Boom, like that. So that's our technical assessment. And right now, the action seems to be bearing it out.
Silver will quantum leap into a new reality. You've just created the title for this YouTube video. I love it. I do want to turn to gold now. Obviously, it's been a very exciting year for gold and gold bulls. We continue to break out new all-time highs, all of that, at least in nominal terms. Rick,
The $33 level is the technical ignition point that both Oliver and Kareem identify independently, and the convergence is significant. Patrick's point and figure analysis shows 3 attempts at $32 resistance, each rejected, but each at a higher base. The triple pending breakout above $33 is not a warning sign. In point and figure methodology, it is one of the most bullish signals possible, indicating that each attempt has failed to produce sustained selling and that supply at this level is being progressively exhausted. Michael's confirmation that $50 will not act as resistance, because he expects silver to simply blow through it with momentum that generates FOMO rather than selling, is the piece that makes the 55 to 60 first gusher timeline credible. The 2010-2011 analogy is apt. Silver went from $18 to $50 in 7 months. A similar velocity from the $32 to $33 base would reach $60 in 2 to 3 months.
Train me, you've got to say nominal because in real terms it's not there yet. Is this the beginning of the next leg up, or is some caution warranted here? Patrick, I'll start with you.
What did he say about gold in adjusted for inflation? It wasn't. Is that his?
It's not at all-time highs. Yeah.
Well, he has to go. Tell him to Rick, go check out my yearly chart because it is above its all-time highs, and that's more meaningful. If you want to get want to look in the future, look at the yearly chart. Remove that noise because by the time it gets to the daily or intra-day spike that it's supposed to be, man, you're going to be, you're going to be late. Like the higher the time frame, the lower the threshold, because it removes the noise from the higher time frames. The lower the threshold to have a confirmed breakout. It takes more time to get that breakout because you need a year, a quarter, or whatever the time frame is. But look at the yearly chart. We're how many months away? 3 months away. Am I doing math right? October, November, December. Yeah, 3 months away from that there. And gold doesn't have to close up higher than it is now. All it has to do is close where it is now, and it's a done deal. It doesn't mean breakouts they're forever, but if you want that, that's what a chart trader brings you, right? If you're above a meaningful resistance line and you break out, then that resistance becomes support. So that's when you have the odds in your favor that move is more likely to go upwards. So yeah, for me, gold, even adjusted for inflation, is looking great. Nominally, it's great. It's stretched. Like we see room that maybe before for the traders out there, like maybe a pause at 2750, 2800. You're getting stretched on the smart time frames. Expect some type of bull flag. But then some people, some of our members, they look, Patrick, after we reach this, whatever, 27, 2800, wherever it does an interim, a shorter term up, are we going to go back to 2100? And I said, goodness, I as a chart trader, I put the image. If you don't mind, I could do it real fast just to show you guys what it looks like, because a pullback to 2100 would look like. Here I have it here. So let's say gold here starts topping whatever 2700. For somebody to expect a drop of gold to 2100, that's a nasty. Like, it's good, guys. Draw lines, visualize. That's going to be a huge type of move down. It's not going to happen like a rocket ship down. Gold, you're still above higher time frames, above a three-year moving average. Everything's inclining, right? Above a 1 year, above a 3 year. When you're above, you're inclining. So for somebody to look at 2100 a pullback, that's a catastrophe, and it could take time. It could take over a year if gold decides to consolidate for like another year or two, like sideways. So 2100, guys, it's for me, it's a big stretch there to go all the way back down there. So wherever we stall, wherever gold look, it's about to stall, guys. It's like, I know it could go crazy, but there's a whole bunch of measured moves that are reached, classical TA moves like up, sideways, up, pull flags. And look here at the bottom, Michael's going to recognize this. This is distance from moving average. I like using the 36-month moving average. So there's room for it to distance itself from the moving average. But once we start getting about 40% above the 3-year moving average, we could have these spikes here. Look, it doesn't mean it's the end of the road. It means you're in profit-taking zone. You could have some type of sideways move here. Sometimes here you could have was a more severe correction, that we're getting close to that, that slowdown. Not quite there yet, but all we have to do is just let the chart tell you. Let it ride. And as soon as you start losing the 12-month moving average or a rising trend line, let's say, okay, I'm losing momentum. Michael's probably elaborate on that. He's going to see it in his charts when his distance from moving average, starts losing rising support lines. He's going to say, okay, well, the momentum's slowing down. Something's happening. Let's just wait until, this resolves. So that's my take on gold. It's been doing what it's supposed to do. The way Michael has probably forecast a while back, the way we've shown it, there was a high probability move to go up. And we're approaching that target where there could be a correction there coming in soon into the cards, but no reason to front run that. Just let the price chart actually start breaking down a little bit on the smaller time frames.
And for those with a longer time frame who aren't traders, it's kind of inconsequential, right?
Oh, goodness. Stackers don't care. Stackers on the website, they educated me. Stacker buys any day. Him, it's ounces. high, low. I'm just a little bit of my pay is going in that. That's fine. Longer term investors, look, you're above a 3-year moving average, a 9-year moving average. You're above a 1-year moving average. Like, there's no reason to sell gold. Like right now, there's absolutely for long term investors, it's in a bull market. It's in a bull market, and once it breaks out versus SPX, then you're going to be in the bull era. That's what we label bull era, like a capital rotation event. So that's going to jack it even more. So it's crazy now because now we have gold's in a bull market. It's been in a while. Silver's in a bull market. It's been there for a while. Higher lows. It's doing what it's supposed to do. But once they start outperforming SPX and the funds from the SPX start flowing to precious metals, that's when you get these crazy targets that people think we're crazy of saying back. But they're going to have a higher probability of happening there once we break out versus SPX.
And Michael, your thoughts?
Yeah, we've got a target. I mentioned a minute ago that I think silver getting through this congestion zone. It's been in since its May high, 32, 32, now 32 again. Okay, you bust through that, and the old intra-month highs, 50. Everybody knows about them. The Bunker Hunt high and the 1980, et cetera, the 2011 high. I don't think that's going to pause or be resistance. I think you're going to blow that out, and that's when you're going to get that sentiment. It says, golly gee, why wasn't I awake when this, why did I doubt it? And you get this gush of, I got to own it. It's above 50, breaking out. Well, why didn't you buy it back at, 15, 20, 30? It's at all the layers of buy signals we generated. But I think that gusher is occurring. If that occurs, my bet is that the gold near-term target, not a top, just a pause, is likely to be 3,000 to 3,200. And there's some reasons for that are momentum based, and not the round 3,000. There are some brokerage firms, I think, talking 3,000. They like to talk big, and they say, oh, in 2025, always looking way out. But I could see us get there very quickly. But on a ratio basis, if gold went to 3,000 to 3,200, only then took a pause, not a top. Okay. I think silver could easily be 55 to 60, meaning be 2% of the price of gold yet again, which is, it's a ratio that silver's had to gold so many times in the last 50 years that it's almost a norm. Okay, it's not abnormal. And then I think maybe you do get a pause, but not at some logical place where everybody says, oh, we're going to pause silver in front of 50 again. No, And I think we built the launch point to blow that stuff out, all the old $50, the Bunker Hunt highs and so forth. And I think it could occur before the end of the year, possibly even before the election. There's a lot of factors underway out there that will impact gold and silver that you've got to look at them and understand, hey, if this happens, that could help generate more power in gold and silver. Few people are talking about the dollar right now. We got bearish on the dollar after its sleepy range for the last year. Since 2023, it dropped from 115 down close to 100, and then went to sleep for a year and a half in like a 5% range, up, down, to going nowhere. It was a non-event market. Major category, foreign exchange, okay? It was a quiet one in the corner. Watch out for the quiet one. It's now just above 100. We got negative when it broke through 104.40. You drop, there's a structure on 10-year average momentum of the dollar index that says when you get into this year, you don't want to see 96 something. You'll blow the hell out of a multi-decade uptrend on momentum. You get into January, that number jumps up to about 98 point something. So literally 2% or so below where you're trading right now. If you're trading there next year, you're going to blow the bridge over the River Kwai for the dollar. Suddenly the quiet one's going to get very noisy.
The dollar chart signal is the macro accelerant that most precious metals commentators overlook, because for a year and a half, it was genuinely boring and gave no signal. Oliver's point about the quiet one is the most actionable macro call in the entire panel for investors who are trying to time their positioning. A dollar index that drops below 96, with the next January momentum level at 98, triggers a structural breakdown in dollar momentum that goes back multiple decades. Every prior gold bull market was accompanied or accelerated by dollar weakness. A structural dollar breakdown in early 2026 would coincide precisely with silver's spread chart breakout timeline and Oliver's summer target for the precious metals gusher. These are not coincidences. They are converging macro and technical catalysts pointing at the same window.
And there's other things going on we know too. The stock market could be a factor.
Yeah, and let's talk about that because you gave me a chart before we hit record here, and I'm going to share that right now. Talk us through what you're seeing here when it comes to the NASDAQ 100 monthly.
Well, the price at top is a price chart. Okay, it's monthly bars plotted in relation, just with the 3/4 moving average overlaid. 3/4 average is, at the end of every quarter, you average the prior 3 quarters and you come up with a new number. It's about as long in duration as a 200-day average, except 200-day changes daily. 3/4 average only clicks gears every quarter, new quarter. Next quarter, I mean in a week, the 3/4 average is going to jump up. You see the little circle on the price chart. That's where that new average will be when you open next quarter. Be about 18,600 on the NASDAQ. Okay, NASDAQ's right, about 4 or 5% above there right now. When you run a quarterly momentum oscillator, where you plot each month's bar in its relationship to above or below where that 3/4 average is, you get a different picture than when you look at the price chart. And you'll notice that ever since turning up from that 2022 low, when we were down close to 10,000, and you turned up, the momentum broke back above the zero line. Okay, the 3/4 average, in other words. And there were 3 pullbacks. One occurred about a month or two after breaking out above the zero line. You pulled back to it and held it. Oh boy, held the average. Okay. And then you shot up. Then you came back down in late 2023 and you sat on the zero line again. Boom, shot up again. Okay. And then last month, when we were dropping from 19, 20,000 level, we said probably you're going to get a bounce at about 17,500. Why? Because that's where the silly 3/4 moving average was. And I'll be darned if you didn't go exactly to 17,500. You traded below it by about 30 points, I think. Maybe it was 100 points, but some trivial amount. And you shot up again. It's like, oh boy, I'm going to hold this line forever. No, you're not. When you build a structure and use it that many times, and it's that clear and precise, it's not subjective where you say, well, it says draw the line. Any idiot could draw that red line. I've got a momentum there. That's a structure from hell. You don't want to break. You don't even want to go back there again. Now, I'll tell you this. Before I started MSA in 1992, I was a futures broker. And I caught the crash in 87. And I caught it using the same type of oscillator here, only then I was experimenting with it. And the price chart of the S&P back then looked just like this one. Oh, it looked lovely. It just keeps going up, little pullbacks, keeps going up. It just, it's going to last forever. Okay. But when you looked at the 3/4 average, it kept for 2 years in a row, just like we've done. It came down to the zero line, zero line, zero line, and built a structure that, you don't see it on the price chart, you see it on momentum. And in the first week of October, you nipped that structure, and within 2 weeks, you crashed. When you look at the price chart, you couldn't figure out, why did this happen? Yeah. Nobody saw it coming. And after that occurred, of course, I then shifted all my technical attention to momentum analysis going forward. Price charts to me were secondary. And right now, this is what we're looking at, is the same type of structure that says you better not sneeze. Now, people say, oh my gosh, if it goes down, gold's going to collapse too. Okay, and that's a whole different issue, but it's a falsehood. And we went in depth in the weekend report showing examples of how if you go back through the decades and circle this, that, the other, stock market collapse. The October 2008 event, which is burnt in everybody's memory, where the stock market already been in a bear market for a full year. It already collapsed in a big way, but suddenly in October 2008, a year off its high, it had a puke. It dropped like 30% in a month. And suddenly gold and silver said, oh, we're going to join you. They've been going up all that time. Stock market been going down for a year. They've been going up. So did T-bonds, by the way. And they suddenly joined in because they were technically ripe to have a correction. They needed it. And they did join in. Stock market kept going down through 2009. It took it several years to even get back to its 2007 high. And gold and silver immediately turned after that October break and took off again. But that's the one example that's burnt in everybody's memory as the truth. And when you go back in history, it is not true. And so now the question is, if the stock market does break.
Michael Oliver's 1987 story is one of the most important pieces of market history education available anywhere in financial media. And the fact that he is seeing the same oscillator structure in the NASDAQ today is not something to dismiss. The three-quarter moving average momentum structure he describes is not subjective. It is a mechanical oscillator with a fixed formula. When the NASDAQ touched 17,500 within 30 to 100 points of his predicted level, based purely on where that moving average was, with no reference to news, earnings, or fundamentals, it confirmed the precision of the methodology. The NASDAQ has now touched that same momentum line 3 times. In 1987, the S&P touched it the same number of times. Then on the fourth approach, in the first week of October, the structure broke, and within 2 weeks, the market crashed. The critical insight for precious metals investors is Oliver's rebuttal of the gold falls with stocks narrative. In every major stock bear market except the brief, technically driven October 2008 episode, gold was a winner. The October 2008 episode was the exception that everyone remembers, precisely because it was the exception.
And you get data points that follow it, which they will. That's how the data points work. They don't usually lead the market down. They occur after. The Fed's going to go apeshit. Okay, they're going to go berserk, and ECB, and they're all going to go back to doing what they always do best: destroy their money units by monetizing debt, by you name it, all the games they play, and that stock market will precipitate the onset of a real to the floor policy by the Fed. And what market enjoys that the most? Okay, gold.
Yes, that's when this is for me like what we call like capital rotation event. It's once the market realizes that, let's say the NASDAQ starts going down 5%, whatever, 10% starts going down. It's fair. Like let's say it's a correction. But once the market, the aggregate of market participants start realizing, oh boy, okay, this is not stopping at 5%. It's not stopping at 10. It's not stopping at 15. Once there's that point of recognition and they realize we're going in for 30, 45, that's it. Because all bull eras again, for precious metals, not just gold going up nominally in price, for gold outperform SPX, the instigator, it's a 30-40% drop in the stock market. In the 60s, late 60s, they did a couple of those. In the 2000s, it was that 40-50% drop. It loves that. It needs that, because for me, that's the true flip-on switch, where afterburners, where the true money, instead of flowing into the SPX and those 401k plans, just all that money slushing in there, the fund managers, okay, hold on, maybe I should slow down the pedal and start allocating elsewhere. And then that huge institutional money comes in once their numbers, their performance. Look, I don't have time to show you a chart on this there to
Patrick Karim's point of recognition concept is the single most important idea in this entire panel for investors trying to understand both the timing and the magnitude of what is coming. A 5% or even 10% stock correction does not trigger a capital rotation event. Fund managers have been trained to buy those dips for 15 years. The rotation only begins when market participants collectively realize the correction is not stopping at a level they expected. In the 2000-2002 bear market, that point of recognition came after the S&P had already dropped 20% and showed no signs of reversal. In 2007 to 2009, it came a full year after the peak. Both times, once recognition arrived, the precious metals move was explosive and sustained. The gold bull era from 2001 to 2011 produced a 650% gain in gold and a 1,200% gain in silver. Patrick is saying that the setup for the next bull era, confirmed by the Dow Jones and NASDAQ already breaking down priced in gold, is in place. The trigger is the point of recognition in the stock market, and we are still ahead of it.
Of course.
To reinforce the point that Michael started with the NASDAQ, I'll just share you this one. This is the Dow Jones because it's the weakest of the main indices, but it's I'll show you maybe SPX priced in gold, guys. And look at this bottom. I have distance from the 36-month moving average. And goodness, look at that. For me to get bullish Dow Jones in real terms, it would have to get back above this line. And it's just falling apart there. I don't know, like maybe there's a longer trend line. It's falling apart. Even the price on the monthly chart, the Dow Jones has broken down. Goodness, you could even say it broke down here, retest. It's happening. The Dow Jones is breaking down priced in gold. And then I'll do the NASDAQ, the almighty NASDAQ, but we know what we're talking about here. We're talking about the Magnificent Seven, right? Because if equal weighted, look at the distance from moving average. It's falling. It's not doing new highs, right? And as soon as it breaks below the zero line here, we're going to start doing new low lows, lower highs, lower lows. It's the beginning of a downtrend, right? And then after that, we're going to start breaking down longer term stuff. Look, we're not doing new highs there. This is priced in gold, the NASDAQ. Maybe it's like it's getting close there. It's getting close to falling apart there. And even that line here, support, resistance, support. So that ratio, like of 7-to-1 for NASDAQ, when gold's worth 7-to-1, it could be a top. Look, it's not this in hindsight. We'll know this was a top. We still need the evidence that could still be a continuation pattern, but the setup is, and the momentum here is not this. This is not giving me hope that this will resolve upwards, right? There's no evidence right now that wants to resolve upwards. We need for the price to distance itself from the moving average. Start running away from it to think that is a continuation pattern, right? So in real terms, right now, the NASDAQ has a setup to falter. The setup's like there. And I showed you the Dow Jones already falling apart. The Russell, forget it. Russell's already down. It's broken versus gold, price in gold. The Dow Jones, and historically over 100 years, the SPX has always followed Dow Jones. They're highly, highly correlated. So where the Dow Jones goes versus gold, you could historically, SPX always went the same way. So, and the NASDAQ is going to do the same thing. So we're seeing in the future now, we're seeing the building blocks of this capital rotation event where I'm just waiting for the market to realize that when the next correction starts, that once they realize that's the one that's going to lead to 30-40% drop, that's the floodgates, man. People start panicking, and so we're still ahead of the curve, guys. It's crazy. Even at gold at 2,600 and silver at 32, we're still ahead of the curve. It's crazy.
The Dow Jones and NASDAQ priced in gold charts are the most under-discussed signals in the entire precious metals bull thesis, and Patrick Karim's presentation of them provides the quantitative confirmation that the capital rotation event is not theoretical. It is already measurable. When the Dow Jones priced in gold is breaking down on the monthly chart, and the NASDAQ priced in gold is failing to make new highs while losing its distance from the 36-month moving average, it means that for institutional investors, marking their performance in real purchasing power terms, stocks have already been in a bear market for some time. The Druckenmiller example is not anecdotal. It is the most prominent public confirmation that the smartest macro money in the world has begun the rotation. Newmont from $32 to $55 in months with no headlines is exactly what Oliver describes: quiet accumulation before the headlines arrive. The wet bar of soap metaphor for the gold mining sector is perfect. When institutional money decides to grab it, the tiny market cap of the entire sector relative to the pool of capital chasing, it means the price move will be disproportionately violent.